We do have a great team and people that work hard and care and, really do understand the mission for helping investors be able to retire better. That's a big mission of most of our people. I want to retire with this extra income, with this secondary business that doesn't cost me my time. And so our team has bought in. We've seen great results. We've created many millionaires, and that gives them, excitement and hope of the good they've done, and also seeing a lot of them start to invest in real estate themselves.
Hey there, I am Dr. Jason Balara, and this is the Know Your Why podcast, where we explore the why behind success. Every week, I meet with real estate investors, veterinary entrepreneurs, mindset coaches, authors, and fitness professionals to uncover their why and how it drives them on the winding road to success. What is your why?
Hi everyone, I'm Jason Balara and this is the Know Your Why podcast. Today I'm here with Jim Sheils. Jim is a real estate expert with extensive knowledge in the build-to-rent niche. He's a partner of Southern Impression Homes, as well as the co-owner and co-founder of 18 Summers, which provides family education services to entrepreneurs and professionals seeking to strengthen family relationships. Certainly we're going to talk about real estate. I'm really actually excited to hear about 18 Summers as well, Jim. But first, thank you for coming on the show today. Thank you for taking the time out to speak with me and my audience. I really do appreciate it.
No, thanks for having me, Jason. Good to be here.
Yeah, absolutely. Well, let's start. As I mentioned, I'd just like to let you tell your story. So let's start there. Let's just hear a little bit about your background, kind of what brought you to where you are today, and then we'll have a conversation.
Yeah, I've been in real estate investing for about 25 years. Went into it because I looked at a bunch of different, always wanted to be an entrepreneur, do business on my own. Real estate kept calling to me. I like the tangibility of it and the statistics of it. At the time that I read it, it said 7 out of 10 millionaires made their money in real estate in the U.S. That now has arguably gone up to 8 or 9. Average person out of 10 has made it through real estate. And so I liked those odds and I went into it. It's obviously not a straight ride, but started doing fixer-upper foreclosures in California 25 years ago. Did well at that. Made my way over to Florida before the 2008 meltdown, which was a very good decision. Although that was still painful, it was better than being in California. And after the 2008 meltdown, I went heavily into bulk foreclosures, which meant I was buying foreclosures in bulk, renovating them, keeping them for myself as rentals, or selling them with investors. And then about 10 years ago, after the foreclosure started to dry up, we started to do new construction. And that's our current model right now, as we work with wealthy and ultra wealthy people to help them create successful rental portfolios, only new construction property. We don't do rehabs anymore. We have lots of reasons why. But the new construction niche is what we do. And we work with about over 1,000 active investors right now.
Okay. Tell me a little bit about the bulk foreclosure and kind of how that worked. Because I think I've had guests on before that sort of worked through that 2008 crisis and talked about what they were able to get from an opportunity, but I've never had anyone talk about, sort of bulk foreclosures. I'm sure the name sort of explains itself, but I'm interested in how that worked and how you structured those things.
Yeah, it's actually a good question, because you're right. It's a lot of times when people say bulk foreclosures, they think, he bought a package of 100 foreclosed homes from the bank or an asset management company. And you can do it that way. I didn't. What I did is I worked on individual properties with REO brokers and just made tons of offers and bought them individually in bulk. And the reason why for me is I would see in the very beginning of the foreclosure days, people would send out, hey, here's 100 properties you can buy. And the problem was 35 of them were really not good properties that I didn't want almost at any price. And so it didn't make sense to me to do that. And also I'd see guys going, I'm working on this 50 house package or this 100 house package. And they'd work on it for several months and then it wouldn't work out. And now they've done nothing. So the way that our business is structured, we said, look, every Monday we're going to wake up and we're going to, by Friday have a few properties under contract each week. So we were still doing a few hundred a year. But more picky on the ones that we chose. So we chose individual offerings, or 1 or 2 at a time instead of 50 at a time, 100 at a time. because we found we got better results and actually did more volume than the people trying to do those other ones most of the time.
Yeah, yeah. I mean, that makes sense to be a little bit more selective about it. I feel like it's if you were buying, a package of 50 or 100 homes, it's almost like the storage unit auctions where people think, they pay a certain amount of money and they're going to hope they get one or two really great things in there, and you probably, but end up with ultimately a lot of garbage. So I think it makes a lot of sense.
Yeah.
What were you focused on? Kind of Florida exclusively, or were you outside the state as well? What markets were you
Florida,
working in?
Northeast Florida exclusively. That's where I did all of my foreclosures in the Jacksonville, greater Jacksonville area. When we went into the new construction model, because we saw how much bigger we could scale new construction, we're in about 12 different markets in Florida now. But for the bulk foreclosures, we were only in Jacksonville.
Talk a little bit about that transition. Like when I mean, I think it's not it's fairly common knowledge that there was a lot of foreclosures after 2008. People made a lot of progress and had success based on that. People that were willing to take advantage of those opportunities, like yourself, and then kind of those foreclosures did start to go away. There wasn't that much distress in the market anymore, and so you moved to new construction. How did you make that transition? Talk a little bit about kind of. I assume if you're flipping houses and renovating, you've got a construction team already. But how did you kind of make that change?
Yeah, it's a good question. And we made the change because, about 10 years ago, the properties that were fixer uppers, the classic fixer uppers we'd want to buy in what areas, they were just too much competition. They were getting bid up, which means if they got bid too high and you bought them at that price, well, you're going to have to cut corners on the repairs. The numbers didn't really work, and we just weren't willing to do that. So the new construction, what actually happened is my now building partner, him and his father owned a property management company with a small building on. And they approached me because they managed my whole portfolio and said, what would you think about building some houses instead of, renovating old ones? So I didn't like it, to be honest with you. I was a rehabber, kind of that badge of honor rehabber. Oh, I rehab properties. But long and behold, I threw in development fees to do a small, about 24 houses in an area where we had done plenty of rehabs of new construction. And it went okay at best, but I could see the difference in it. There was less headaches, there was less surprises. You were able to build in a little bit of better areas, attract a better tenant. In fact, our tenancy from the old fixer-uppers went from an average of about 13 months to today, our new construction's at about 3 years, the average tenant stays. Wow. So that's a big difference. So teaming up with my, the person who managed my portfolio, again, we were in management before we were in building, or they were. And then we just started to do more and more together. I opened up kind of my Rolodex of investors over the last 10 years and said, hey, this is what I'm switching to. I'm not doing old fixer-uppers anymore. And we kind of built it from there. So it was an existing relationship that building wasn't our focus, but obviously over the last decade, it's become our focus, along with management. Because I remember a mentor said, you can buy a house at 50 cents on the dollar, but if you don't have management in place and you're afar, you can lose money. And so, that building and management together is really key to our operation.
You mentioned, going to your existing investor database with the house renovations. How did you structure that? I guess how were you raising capital, and did that change when you moved to a build to rent model?
Yeah, when I first was doing foreclosures, then I had investors that would just loan money to us at a flat interest rate, and we would use that money to acquire, to renovate, and then either resell or refi them out and keep the property for ourselves. And for our investors, investors who were looking for the end product, all they had to do was get a permanent loan at the end. We would take care of the construction phase and the acquisition phase and get it turned around and tenant occupied, and then they would step in. But it was we did some small land funds when we first got into building. But since then, we don't have any land funds or anything. We're actually now partially owned by a group called Sumitomo Forestry. They're about 330 years old, out of Japan. You'll look up that Warren Buffett's very heavily invested in one of their other conglomerates. And so they work like a Warren Buffett. They've paid off all of our bank debt, and they fund all of our building projects. So we don't have to work with banks at all for our needs, which is great because right now builders are kind of getting beaten up by the banks because of unknown times, but we're able to build our things. So we don't raise capital anymore, and we actually don't have any bank debt at this time.
That's fantastic. How does something like that come about?
That
I've
was all
heard
my
of.
that was all my partner and his father. It had been built up to the point that it looked like someone would want to buy it, but I've had friends that have gone the route of private equity groups. And not that there's not good ones out there, there are, but there are a lot of bad ones out there that just kind of dismantle, and destroy the company for the most part. And my partner's father has since retired and is enjoying that and well earned. But he's only in his mid 40s and I'm 50, and we're not looking to retire as long as we're enjoying the work. So you don't want to just team up with anyone that will buy into your company. You want to have someone that's going to look for it long term. And what we saw is with Sumitomo, again, my partner put this all together, but in the research that we did, if someone has what's called a 2 or 3 year earnout, we were finding builders that did this deal and now they're still there 10, 12, 14 years later. So they had the ability to leave and they chose not to leave for many years. And they said, why did we leave? They're great partners. They treat us well. We're well funded. The connections and the suppliers we've gotten, because they do 17,000 homes worldwide, they give us autonomy. So that was a big piece of it. So you got to really pick and choose. And also kudos to my partner who, I merged my company a few years in, but him and his dad starting it, they built a really successful, strong balance sheet company. And a lot of real estate investors are fly by the seat of their pants, hidden debts, robbing Peter to pay Paul, and that will show if you're trying to get a bigger, very sophisticated group to buy into your company. Eventually, that's going to catch up for you, and they're going to look at your books and say, absolutely not, pretty quickly. But kudos, we built a solid business, and they love the build to rent. They had never worked with a company that specifically was building for investment properties for investors, and they really liked that idea.
Yeah, that's the. I mean, sounds like I'm sure there's a lot of processes and things to work through to get into that type of partnership. But I mean, that really does sound like such a great position to be in as a builder or investor in any capacity. Just having someone like that who can, especially you said they giving you autonomy. I think that speaks to both sides. It speaks to, like you said, creating a company with integrity that's worth someone buying into and doing things the right way, and then finding that partner. I think that's kind of I mean, ultimately seems like would be an end goal for almost anyone. Although, like you said, I think it's a lot harder to get in that position because people are kind of teetering on the edge sometimes with the companies that are built. So, I mean, congratulations to you and your partners and stuff on that. I think that's a phenomenal position to be in. What do you see, kind of as the future of me? What you said, it's been about 10 years of build to rent. Do you still feel like we've had, a fairly significant market shift over the last couple of years? What have you seen maybe hasn't impacted you if you don't have any bank debt? So how is these last couple of years gone for you?
Obviously 2021, 2022 were busier than 2023, 2024. And a lot of that came because in mid 2022, the interest rates did that hockey stick upwards. And that affects our business. Everyone says it doesn't, but of course it does, because especially whether it's us or multi-unit groups. And we do duplexes and quads. So we do smaller multi-units still in the residential realm, but even up to the bigger apartments and such, that really affects their serviceability and sense of the deal when the rates jump.
Mm-hmm.
So we've all been waiting for those rent rates to drop. I mean, just this fall, we were at a 26-year high. So what we've seen is actually a positive thing where it's been semi-recessionary the last 2 years. And that means that, there was more COVID inventory that came on the market at the beginning of last year. And so that took the properties from a 30-day average fill time to a 65, which people got freaked out about. But the interesting thing is, since that, back in June of 2022, we've really had a diminishing effect on permits being pulled. We are way down on permits for the last 2 years. And with all this COVID inventory coming on, in about 6 months, and I've done some talks on this, we're going to see another inventory shortage. If the statistics don't lie, you cannot it's not like, we can, you name it, a lighter. I got a lighter here for my incense candle. So if this lighter, I need to make 5,000 more of them, I can just do that probably pretty quick in a factory. With houses, you can't do that. I mean, you know that, Jason. It takes time to get it permitted and built. I mean, you're talking at least a 2-year lag that we're probably going to hit this mid-year. And so what we're seeing in the more affordable markets that we're still seeing influx of population, there's this COVID inventory that's come out, but it is being diminished quite quickly. And over the next 6 months, it should be gone. And we think there's going to be another upward pressure on rents and prices in the affordable working house areas. Again, we don't do luxury or anything like that, but that's what we're seeing.
Yeah. Yeah. I think that makes a lot of sense. I think we feel similar in the multifamily space that there was a lot of inventory that came online last year, and now there's just essentially no permits in the works, and so there is definitely going to be a lag in supply. Where do you're focused still kind of in Florida? Is there plenty of land still to develop? Do you feel like that side of the business, because you've got a great structure in terms of the actual building, locating land to build on? Do you find any supply constraints there, or how's that work for you?
We were very lucky, and I guess we have to credit ourselves a little. We created our own luck, where in the beginning of 2020, when the pandemic first started, we kind of made a decision and said, we're either going to be really right or we're going to be really wrong. This is either going to be really good for real estate or really bad. And we had enough advice to say it looked like it was going to be really good. So we doubled, tripled down and bought a large position of lots and land in the markets we wanted to focus on before the big spike in prices going up. So we're sitting on over 5,000 lots right now. And so we work, we have a full land acquisition team off market. We're still finding land, but again, prices went up. So it's tougher. And the good thing is the reason we're allowed to build still, Jason, is we got into land right. If you don't get into land right, it can kill the whole deal right away, especially on smaller single families and duplexes. And luckily we got into the land rights where other builders right now are trying to find land, but they're having to buy at today's prices. And we've seen some settling in prices, but definitely not down to where we were buying at, before any of the COVID jump. So we're not having a problem with land just because we stocked up. So we feel very lucky about that.
I'm curious kind of what maybe this varies on different factors, but like what is the time frame to go through 5,000 lots? I mean, like in terms of just a build rate, how long do you think it will take you to build out all those lots? Just
if we hustle, 4 to 5 years.
Okay. Yeah. So that's,
Yeah.
I mean,
it could be quicker. It could be quicker, especially with some bigger groups, because we work with not only the individual investors, but we work with family offices and some of the institutions as well. So that could go even quicker as well. But I think 4 years is a good number.
Yeah. Yeah. I mean, even that does seem fast. You're building, 1,000 lots a a year basically to get to that rate. That's impressive. Um, how I mean, you to do that, to build at that scale, I mean, you must have created a pretty large team company. How do you um,
Yeah,
sort of
we have 140 people on the team. My partner handles all operations and management. He's the CEO and president, and all I oversee is sales and marketing. So that's my specialty. I know the mindset of our investor, being an investor for a long time, being in that part of the game. So, we really do. You have to become clueless in your own company. I remember someone saying that in order for it to grow, because you become the block of growth. So there's a lot of things I'm not on top of. I'm not exactly on top of where's our dev team at on this? Where's our land acquisition team in on this? I'm focused on one thing, and my partner oversees all of the bigger pieces. There's key people in charge of those things now. You can't do back in the fly by the seat of your pants, one small rehab crew, two admin people, and go. It's you try to run it like that now, but with this size, our management team alone has 50 people. So it's a different type of business, but you need to have good people, and we do have a great team and people that work hard and care, and really do understand the mission for helping investors be able to retire better. That's a big mission of most of our people. I want to retire with this extra income, with this secondary business that doesn't cost me my time. And so our team has bought in. We've seen great results. We've created many millionaires, and that gives them excitement and hope of the good they've done, and also seeing a lot of them start to invest in real estate themselves, which is pretty exciting.
yeah, yeah. I do think watching your team grow, watching investors have success and grow is kind of one of the real estate's the vehicle, but it's a great just feeling to see that happening around you. I feel like that's a good sort of transition into asking you some of the questions that I ask every guest. The first one
Sure.
is what is your why? I feel like probably you touched a little bit on it there, but um, obviously a ton of success, Jim. I think what you've built is incredibly impressive. What you mentioned earlier, you're not ready to retire. You're not to an age where you want to stop. What keeps you going? What keeps you kind of excited about continuing?
I like the strategy and venture that we're working with people right now. I want to continue to build my own real real estate holdings and wealth as well for other things I want to do. Yet for my lifestyle now, I'd be fine, but I'm looking extra generational and some other things I want to do. So that keeps me going. I love taking adventures with my family. I have a wife and 5 children, and I didn't get that with my parents. They couldn't afford it. So what keeps me going is, I think funding adventures and being able to fund even more adventures and causes we care about, whether it's supporting an orphanage down in Guatemala or a school, an alternative school that our children attend right now, that my wife and I are heavily involved with and provided the land and the property and other things for. These things, cost money, and I like to keep an income coming in where I can still be doing these things and living my hobbies, but also building my wealth. So I think I'm in a good equilibrium right now to continue to do both with people that I enjoy working with.
Yeah, that's great. Let's talk about 18 Summers. Tell me a little bit about that, the vision behind it, kind of what that's meant to you. And I don't have 5 kids. I have 2 kids. The idea of having 5 is
Ah,
frightening to me, but with the 2 that I guess maybe get to some point where it's like you just
we had a break,
almost
yeah, and there's
everything
in
at home.
different ages, and yeah, my wife always had a thing. She said, once you have 2, you can have 10. I'm like, yeah, we're not going to try that, but we'll go
Yeah.
5. Yeah. Um,
Yeah.
but a lot of times I got into real estate very young, and had some success, and so got invited to some pretty big groups to speak at some pretty big events, and I saw some things behind the curtain that really deflated me. Guys with huge balance sheets and absolute disaster family lives. I mean, non-existent personal lives. And that couldn't be unseen for me. And I've had that since a young age where a lot of people go, wow, that couldn't be me. That couldn't be me. I always said that, man, that could be me. That could be me. And it scared me. So I wrote on a whim, and people, when I started to share some talks of little strategies my wife and I were doing with our two oldest sons, people said, wow, you got to write a book on this. I said, I'm a real estate investor. I'm not a family psychologist. I'm a therapist. What do I have to share? And luckily, we were pushed by some pretty influential people to write it. And it changed a lot of lives, including our own. And it's about how do you be successful in business and successful at home? Because I see a lot of bad information out there, Jason. Gosh, I hope you haven't listened to it. It came around when I first, when I was in my early 20s. Mm-hmm. Put your head down, go hard for the next 5 to 10 years, your family will understand. I think that's horrible advice. If you have a family, that's terrible advice, because the years are not all created equal. Something my friend David Bach said to me many, many times. And you have to be in both places. To delegate yourself out of family life is an absolute crime. And I've watched it. Just all the wealth that some people have created is worth very little to them because they sacrificed their family through those first 18 summers. And you don't get those back. And people say, oh, this, we get a lot of heat about I don't know, if you look it up, it's pretty interesting to watch. We get a lot of heat. Oh, there's this thing, 18 summers now, that you only have 18 summers with your kids. I think this is very negative. It's acting like they don't. And that's great. We love kind of the conversation around it. But from what I've seen, for the most part, we named it 18 summers because the average person will spend almost 85% of the quality time they ever have with their child by the end of the 18th summer. That's something I want to know. And my two oldest sons, I adopted at 7 and 5. So I was already behind the 8 ball, I felt. And that gave me a positive kick to the rear. And so we just shared that, and it resonates with most people. But 18 summers is really we just do talks, workshops, some events here and there. But it's been a side passion project. And the book is hit #1 on Wall Street Journal now, which we're very gracious and appreciative of. I don't think it's because the writing's that great, but the message is so important to people. Yeah. That's what it's about.
Yeah, my kids are 5 and 3, and it becomes more and more, I don't know, like front of mind, just how you see how fast they grow and how development, especially at a young age, and the amount of time that you have with them just becomes really more and more clear to me that it's not going to be as long as I think or as long as I want and all of that. And so it's I need to get your book and read it for sure. I've definitely looked at, my next real goal is I want to be in a position to take summers off with them. Just be able to do whatever we want during the summer and go, whether that's to travel for the summer, even just be home together. I think that's because I agree, the years are not all the same. And no, it's not like you stop seeing your kids after 18 years, but then they develop their own lives. And it's unless you're following them around, trying to be some sort of third wheel in their life, which they're not going to want that as much as they do when they're young. So I think it's so important.
And with the 18 summers, the odds of them wanting to spend more time with you after 18 summers, if you did the first 18 right, are much higher. And no one wants to look at that. Where if you were a stranger, if you were kind of a unavailable or impatient, kind of edgy, never really completely there, and when you were kind of grumpy and always consumed with business, why would they want to hang out with you afterwards? And that's where a lot of people don't want to look at that. But a lot of people, thankfully, have shared that to me and says, I wasn't there. Even when I was there, I wasn't there. And I became almost like a part-time disciplinarian or just an ATM machine. And now I don't have much of a relationship. And that's really sad because the people that I see that plant the seeds and do those first years right, not that it can't be, it can be salvaged at any age, I believe. However, they have better odds. And then again, remember, the average person has spent 85% of the quality time they had by the end of the 18th summer. I think for my kids, because my oldest now are 21 and 19, I think I still have 30%, 35% more time with them because I'm so intentional. And also I feel like we did it right and they still want to hang out with me, even when they don't have to. So that's a key element people should really remember.
Yeah. Yeah. I love that message. Just, creating the environment that they do want to spend more time with you, that it's not, kind of they're not trying to escape as soon as they get to an age that they can. And I think that's such an important piece. Jim, when people hear this and they want to connect with you and reach out, what's the best way for them to find you?
Go to jjplaybook.com. JJ Playbook is Jim and Jamie Playbook.com. My wife and I put it together. It's some starting points of our real estate adventure. You can see a free download of our best-selling real estate book on that, of how we built a portfolio that doesn't take away all of our time so we can be with our family, and also more about kind of our business if you're looking to get into real estate investing or are in it and wanting to have properties that are easier with better numbers, then I highly recommend new construction.
Yeah. What message would you give to someone who they've heard it, they want to get started in real estate? Obviously they can connect with you and find, some of that through these resources, but where would you tell them to kind of start?
I would start, I just released on New Year's Day a story about where I was trying to start my real estate investing company. And I went to go see an attorney after I'd already done some deals and made money to set up entity structuring at that point. Mm-hmm. And this guy sat there and berated my business idea and told me I was probably going to be waiting tables in a few weeks and just completely destroyed it. And it's the whole thing of, he had no real estate investing experience. Yeah, he was a lawyer, an entity structuring lawyer. He had no experience. And everything he told me, when I can look back now as an experienced real estate investor, not only on investing itself, but also the area in Central California where I was going to invest, he was 100% wrong. I mean, he couldn't have been more wrong on anything, but he said it with such confidence. And, for a young person in their early 20s in this guy's big fancy office with very little track record, that was scary. But I'm glad I didn't listen to him. And my long about way of saying this, Jason, is don't listen to people who aren't in the game. If you go to a person who's never invested in real estate and you're asking them for advice, the odds of them giving you good advice or encouraging you to move forward are very, very low. So find someone who's been in the game, has had success, and see if they have principles you can understand and follow. That would be my best advice.
Yeah, I think it's great. We've talked a lot about mentorship and the importance of that, and it's a great business to be in. It's not always easy, and so having that kind of support system of people that have done it, and I think there's a lot of negativity or fear around what could go wrong, but when you get in the rooms with the people that are doing it, you get to be more about what can go right, what how much of an impact you can have and all of that. So I think it's a great message to end on. And I just want to say, Jim, thank you so much for coming on the show today. I think there's a ton of value here. People will get a lot from this. I'm very appreciative with what you shared. So thank you very much.
Oh, great to be here. Thanks for having me, Jason.
Yeah. And folks listening, I know you're going to love this episode. Make sure you connect with Jim. Please like, rate, and review the show so we can get more great guests. And thank you all for listening.
Hey there, I am Dr. Jason Balara, and this is the Know Your Why podcast, where we explore the why behind success. Every week, I meet with real estate investors, veterinary entrepreneurs, mindset coaches, authors, and fitness professionals to uncover their why and how it drives them on the winding road to success. What is your why?